Hi, I'm Diane Lim. I'm Senior Advisor here at the Penn Wharton Budget Model, and I'm here today with my colleague Rich.
Richard Prisinzano, the Director of Policy Analysis here at Penn Wharton Budget Model.
And we're here today to talk about our new wealth tax analysis that Rich led up. And the wealth tax issue is a kind of challenging one for us and all tax economists everywhere. Why?
Yeah, I think there's a couple things, right? So in the U.S., we don't have an example of a wealth tax. We do on the local level through real estate, but we don't have anything on the federal level. And there's only really a few countries we can look at for an example. You know, some Nordic countries and some others kind of through the world. So first difficulty with this is figuring out what the wealth base is. So we've got to estimate what the wealth base is. There's some estimates out there. We looked at the literature, figured out the ones that made sense. And then the second piece is figuring out, okay, so now we have the wealth base. Now we've got to figure out how are people going to respond to the new tax. And if there are elasticities out there we can apply in this situation. And then we have to apply our understanding of the tax code and behaviors people can take and things they can do to avoid the tax. So ultimately, we come down that the tax, which is 2% on wealth above 50 million and 6% on wealth above $1 billion, that it raises $2.7 trillion over 10 years starting in 2021.
And so, incorporating macroeconomic effects, our revenue estimate is around $1 to $1.4 trillion less than the Warren campaign estimate over that 10-year budget window. We go into detail as to where those differences come from in the report. Now, the wealth tax sounds kind of small because it's like 2% and 6%, but that's off a wealth base. You're talking about an effective tax rate on an income basis that could be more than 100%. I would think that that's going to change economic behavior a lot. How did you model the macroeconomic effects, and what did you find?
We applied the revenue raised from the wealth tax in 3 different ways. The first is the standard application of the extra revenue to deficit reduction. We then also applied it to a new government program that did not change productivity levels. And then thirdly, we applied it to a new government program that enhanced productivity. We found that the standard approach reduced the size of the economy by 0.9% in 2050. When we applied it to the spending on government programs, the one that has no productivity enhancement reduces the size of the economy by 2.1% in 2050. And if we spent it on a program that increased productivity, we see a reduction of 1.1%.
So even if we assume that spending boosts productivity, the size of the economy still shrinks compared to the standard approach of applying revenues to deficit reduction. Did you also vary other assumptions in the model?
We also allowed for different amounts of avoidance behavior. So we have what we call a static or truly static or mechanical estimate that has no behavior built in. These different amounts of avoidance translate to different effective tax rates in our dynamic model. The situation where we raise more revenue, so there's less avoidance, the effective tax rate is actually higher and it shrinks the economy more in relation to one where there's a lot of avoidance.
So there's a clear trade-off here for policymakers between revenue raised and economic growth, because that avoidance is lowering the effective tax rate, so the tax has less of a burden on investment. Now, if people watching go online and get into the report, it does include an interactive feature where they can test out the model's results under other combinations of assumptions. So everyone should go check it out. Thanks for your time, Rich.